Hello, everyone, and a big welcome from us to our seminar today, Building Your Financial Future. My name is Diana Zhao, and I'll be one of your hosts today. I've been in the financial industry for over a decade, helping participants such as yourself through their financial journey. And I'm pleased to be joined by
Hello, Diana. Thank you, everybody. Thank you for joining us today. My name is Jesus. As Diana said, well, I do have a little bit less time than Diana. I've been in the industry for a little bit over 5 years. But yes, we are excited to be here today. We are excited to have you here today. And with no other to say, let's go jump into the topic that we are covering today, Diana.
Exactly. Yeah. We are going to be talking about 6 steps to financial success. And these are crucial steps that can help you build your financial management wherever you fall and what you're going through. These steps are here to help you. And keep in mind, we'll be together for the next hour. Send in your questions, please, because we're covering different parts of your financial management. So let's jump right in on what we're going to talk about here today. These are the 6 steps. Protect what you have, control your cash flow, invest wisely, manage your taxes, save for retirement, and leaving a legacy. As we go through these, and as you're going through life, you're going to make plans, and those plans are going to adjust and change just as you are as you're growing. So, know that as you're starting off with that first paycheck, you may have started with just saving, maybe spending more than saving. And then from there, we'll keep going into them. So we'll dive right in with our first topic here of protect what you have. And again, please send in those questions. When we are talking about protecting what you have, we are talking about you. And most importantly, we're talking about insurance and the coverage of what you have and yourself. As you can see, there's lots of options when it comes to insurance and what you're insuring for. First one, property and casualty. Here, home insurance, renter's insurance, we're looking at. There's long term care, and this comes into play in your latter years of life. It could be nursing home care, maybe in home care, someone to come take care of you at your home. Disability income, just like it sounds, if you're not able to work, if you become disabled and you need insurance for that. Liability, this tends to fall under car insurance, right? You'll get your car insurance and liability to protect for covering legal costs and payouts to any third parties if you're found liable. And then the bottom two, these are really big ones, aren't they? We have medical. Got to take care of your health insurance, right? Make sure you're covered. Most likely, you're going to get this through work. And then there's life insurance. And life insurance, we'll probably get it through work and outside of work. And we'll talk more about life insurance, aren't we, Jesus?
Yes, and as a matter of fact, Diana, I like that you left these two at the very bottom, or I would say at the very last, because when we think about what we have, we normally think about property. We normally think about like I don't know, my house, my car, my bank account, but we sometimes we forget about to our health, which is something that we have, and our life. Those
Right,
can be like do those two type of insurance or those two have property that we do have, right?
right, right,
And medical insurance, as a matter of fact, can be a little bit expensive. So, and that would be something that you may want to keep track of, because if
right.
you are taking the advantage of having a medical plan through your employer, then it can be a little bit cheaper. But keep in mind that there are still some premiums, there are still some deductibles, there are still some co-insurance, depending on the plan that you are. And that actually takes us to the next step that we want to talk about, which is your cash flow. Because remember, at the end of the day, the insurances that we are paying for, we will be paying some of it. And as I said, it can be from premiums to co-insurance to deductibles. Um, and that will be something that you may want to add within your cash flow. There are different, I would say, type of things that you may want to consider when you are thinking, when you are planning for your cash flow. The very first one will be assessing your current asset situation or your current situation. The easiest way to do so is using a budget. You may want to know how much you are making, how much you are spending, where you are spending, where can you cut a little bit those expenses. Remember, think about this. How much of you are spending on maybe Amazon or maybe Starbucks? You may not want to know, but once you know, then you have the option to cut those expenses. Also, on top of that, it's highly important to have your emergency fund. Having an emergency fund will give you peace of mind that no matter what happens in the future, you are, I would say, you are protected yourself. You are protecting yourself. We don't know what can happen. It can go from maybe replacing your cell phone. It can go to, I don't know, medical bills, God forbid, but it can go to anywhere. So having your emergency fund, it's going to be a huge, I would say, impact on your life. It's going to give you a lot of peace of mind. Also, and this is something that I always like to take very slow, paying down your credit or your debts, like either paying down or pay off if it's possible. When I do have my one-on-one meetings, sometimes they ask me like, what's the best investment that you can have? And I always tell them, pay off your credit cards. And people sometimes is like, what? Are you telling me like an investment to spend money on paying my credit cards? And the answer is yes. If you pay off your credit cards or when you pay down your credit cards, you will be saving a lot on interest. That will be something that you may be looking at. How much of interest are you paying? And there are some good strategies for you to pay off your credit cards. Aren't they, Diane?
Yes, absolutely. And thank you for bringing that up. There's two ways you can pay off your debt, especially when it comes to credit card debt. Those high interests really eat up. So I think Jesus is right. It's a great way to invest back in yourself. Now, start on the bottom line. Make sure to pay all your debt on time and pay those minimums because you need to know when those are due since it affects your credit. So it's good to make sure that's set and ready to go. Now, your first of the two options of paying down credit card debt is the faster method. It's called where you're going to put a little bit more money to the debt with the highest interest. Mathematically speaking, you tackle it faster and you get through your debt faster. Now, the second option is the one with the lowest balance. That one's more psychology because you'll start to see that with the smallest balance go down, down, down quicker, and that will give you motivation to keep going. And when you're paying your minimums to each one with the two methods, you're putting a little bit more. It could be $10 more, $20, $50 more, and you're attacking that debt to get to the next one, to get to the next one. And when you do so and you finish one, you can then move to the next step, put 100% of what you were paying in the first one to the next one, or you can then put some of that to some of your savings vehicles, can you?
Yes, and there are actually some ways for you to save your money. There are what we know the traditional savings account, the saving account that we've been using for maybe 50 years, right? However, let me tell you what's the thing here with the traditional savings account. Normally, they will not give you any kind of interest, right? So that's why there are some other type of savings account that they will give you some interest. Those savings accounts are known as high yield savings account. Most of the financial institutions will give you or will offer that option. And with that option, essentially, you do have a savings account. That money is always available, and they are giving you some interest rate. That interest rate fluctuates along with the Federal Reserve interest rate. So you will see that interest rate going a little bit like fluctuating. But at the end of the day, as I said, versus a traditional savings account, it is giving you some interest. Another way for you to save your money and make some money out of it is what we know as CDs. And it's not compact disc, it's just certificate of deposit. right? So the certificate of deposit is essentially what you buy these certificates and you put your money invested for a certain amount of time, which normally goes around like 18 months, 12 months, depending on the how you buy those certificates. And they will give you some interest at the end of that period. What is something that I don't like of these type of savings vehicles is that your money will be frozen. So for this time, like 12 months, 18 months, the money will be frozen. So just please use this vehicle if you have that money and you will not be using this money whatsoever. If you need the money available, then a high yield savings account is a good option. Another good option that you may be seeing on different, I would say, investment accounts is to put your money on what we call the money market funds. There are some investment funds that is based on money market. Essentially, it works pretty much like a savings account. It will give you some rate of interest. However, normally they are the lower interest rate or the lower rate of return when we talk about investments. Why is that? Because they are the safer investments. And when I'm putting that on quotes, is because every single investment will have some risk. It can go from market risk all the way through even just inflation. So every investment will have some risk. And then when we are talking about investment, then we jump into our third step, which is investment. And tell us a little bit about it, Anna.
Yeah, great segue because when you're investing, you'll have different goals. Naturally, we all do. Like he said, with CDs, you'll have can I have my money stay there for a certain period of time or can I not compared to a mutual fund, excuse me, the money market mutual funds. But when we're thinking about investing, this takes on a whole new life because most of us growing up, we were told save, 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 save. We all heard that talk. But when it comes to investing, what does that mean? And especially investing wisely, where does the wisely part fall? And actually, that part falls on you. So I have a poll question to ask. Think for yourself, how did you learn about investing? Think back to when you first heard about it. Are you self taught? The other one is, did you learn in school? Like myself, I went to school for finance. Did your parents teach you, or maybe there was another option you learned about investing? And the reason why you want to think about that because this is a new world and it's something that's a powerful tool. Albert Einstein said compounding interest can really help you while you're saving for your future because it's an eighth wonder of the world. It's amazing. Now, when you have longer term goals, investing really kicks up a notch to help you. And when you're looking at that, what do you have available to you to invest in? You have your mutual funds. You also have exchange traded funds called ETFs. Now, of course, you have more than this, but this is where we're going to start because it's a very, very common place. Now, of course, don't worry about what's being written here. We'll cover all that for you so you don't have to read and listen. But when we're talking about the two, in essence, they're pooled investments. You'll get a combination of stocks or a combination of bonds, or maybe a mix of both. Think like a bag of Skittles. That would be a mix of the two of them together. And then you would decide what would work for you when you're creating what's known as your asset mix. You might hear the term asset allocation, investment portfolio. It all means the same thing. Your mix between stocks and bonds. And then you decide what mutual funds and ETFs you want to invest in. With mutual funds and ETFs, those are created and sold by investment firms, is where we see those. And what you want to do is pick how you want to choose them. Now, also keep in mind is where you'll see them and what type of account you'll use them for. Generally speaking, mutual funds are common in our employer sponsored plans. You'll see them, you'll get a list of what you can invest in as you're making your contributions, and you can pick stock funds, you can pick bond funds. Some are index funds that follow a certain index. Let's say the S&P 500, you might see a 500 index fund, and it does what that index will do, has the exact same companies and follow along. Actively managed funds is where a fund manager is picking different stocks and bond companies to build it. Because how do you decide? Should I be in Google? Should I be in AT&T? Should I be in FedEx? You don't have to worry about that. Get yourself a mutual fund or ETF. On the other side, you can have an ETF in a taxable brokerage account or even a retirement account like an IRA. We see answers coming in, and I'm actually seeing answers across the board. Lots of A's on self-taught, so that's good to see. But keep in mind, ETFs work a little bit different from mutual funds when it comes to how they're traded. With mutual funds, you'll buy and sell a mutual funds, and that trades one time, which is at the end of trading hours of the markets, which is close of business 4:30 Eastern time. But ETFs kind of give you some more wiggle room. They trade like a stock, so you can trade it throughout the day. So if you wake up and you're really excited about a certain ETF at, let's say, 9 o'clock in the morning, and then by noon you're over it and you want to sell it, you can. You can get a little out of hand with these, but you don't have to sell them throughout the day. It just gives you that option, doesn't it, Jesus?
Yes,
Now,
definitely. I am
mhm,
looking at some of the questions, and I just want to mention something. It says like Jeannie or Jenny. So, sorry if I'm mispronouncing your name. It says that through her work, and I love that. I love that. I love knowing that your employer is worrying about giving you some financial education. So props on that. All right. Also said Beth says that she was taught by her husband. And you know what? That's something that normally, well, I would say ideally we discuss in a couple, but
yeah,
sometimes we do not. Sometimes we do not
yeah,
discuss like expenses, investment, and that's something. And Beth, once again, pray to that you are
yeah,
discussing those topics with your partner.
yeah.
Also, I see a question here, Diane. It says, I am ready to learn more about investing. Right now, I contribute 15% to my 401k and max my Roth. Where do I start? And I want to say, Diane, we will be talking about the 401ks and the Roth IRAs. But when it comes to where to start to your investments, as Diana said, I will start with a goal. That means how long you have for that money to be invested. The longer you have, normally the more risk you can take. The shorter you have, normally the less risk you can have or you can take. With that in mind, I will say set up your own or define your own risk tolerance. With that, then you can decide either if you want to manage that on your own or if you want to have somebody helping you. There are some options where you can actually have somebody helping you to do your investments. Not necessarily like having somebody managing your account, but it's somebody managing the fund by itself. Because I actually that's part of the conversation, right, Diana? Is
Yeah,
it the next one?
it is. You're right on it.
Okay. Do you want to talk about it?
Sure, sure. Just like you said, a benefit in your 401k, when you'll see those list of funds that you can invest in, you get benefits from them. And we'll go through all of them, but I'll start with the one that Jesus was talking about was the professional management. Because mutual funds are created by investment firms and the managers are the ones who create the different types that you see there, you're already getting that help, right? So then what you need to do is decide which one is good for you. So with that list, you'll see that there and you'll get that. Additionally, you'll get convenience. And the convenience being is that with that list you have available to you, you can figure out which stock ones you want, which bond ones you want, based on what Jesus said, your timeline to when you'll realistically retire, and then also how do you feel about risk. Now, keep in mind, as time goes by, you're going to adjust that because they also give you flexibility. As you get closer and closer to retirement, your asset mix is going to adjust, and the funds that you're investing will also adjust over time to become less and less risky because you're getting closer to those retirement years. And while you're changing that as you go along, you're helping yourself account for that time frame and for the future years to come along. And then lastly, probably the best benefit, I think, is diversification because you can spread yourself. You can have stocks and bonds, whether it's indexed or active, both domestic and international. So then your success isn't measured by a particular company or a sector. You're giving yourself the beauty of allowing yourself to be diversified. And also keep in mind, diversification doesn't eliminate your risk. Jesus was talking about there's always going to be some level of risk, and that does come with investing. So when you're thinking about your risk tolerance and what you're comfortable with, do know when you invest, some of that has to account for your money working for you, especially with the goal like retirement. And you have a multitude of things that you can invest in out there. So where do you start? Let's talk about what you have available to you. So then you can get an idea of thinking, I feel good about these compared to these other ones when we're looking at diversification. Please know this is not an exhaustive list. It's just a great place to start when you're looking at categories on how to group them. We talked about the money market funds, great for those short-term goals like your emergency fund, saving to buy a home. Those are great for that. Next, you have your municipal bond funds. And just a heads up, this list goes from the most conservative to the risky ones. So we'll go in that order. With municipal bond funds, the idea about these is to give you some sort of tax-free income. Now, generally, you'll get federal tax-free income, but if the bond is issued in your state, you may also get state income tax for free as well. And if it's even issued in your municipality or your city, you can get those for free. Now, if you buy a bond from, let's say, the state of California and you live in Massachusetts, of course, you're not going to get the state tax exemption, but you'll still get the federal one. From there, most of these are, the name is what it does. Income funds are in income producing securities, and you're looking for that income. So it have bonds that give you that monthly interest, or stock companies that are called value companies. They've been around for a long time and they produce a dividend. Common ones, your Coca-Cola, Disney, those companies have been around for a long time and they give you that quarterly, maybe semi-annually or annual dividend that comes along. Growth funds, these are companies that have potential of growth. A common one would be like Google. It's surprisingly a big firm, but it's not an old firm like your Coca-Colas, is it? And the idea is you buy it as a stock price, and we hope the stock market goes up and up and up and up, and we get to enjoy that ride. Combine those two together, you have those growth and income funds. You get a little bit of growth and a little bit of income. You decide which ones that you see that you like that ratio of growth to income. Followed with that, balanced funds, similar to growth and income funds, but here we're looking at one fund that has both stocks and bonds. And when you look at these funds, they'll have a ratio. It might be 60% stocks, 40% bonds, the vice versa. They'll usually tell you what kind of combination that is. You might also see those funds that are called like target date funds. They're very common in employer-sponsored plans, and they have a year in its name, and they'll have that mix of stocks and bonds together because they're invested in other mutual funds, and they're targeted to a specific year you'd think you'd plan to retire. So that's another place you can start. From there, we have international funds. And international funds are different from global funds because international funds do not include the United States. So you might invest in a European fund, so it's only European companies. Or you might be in Asia with only Asian companies. These are important because of all the companies out there in the world with stock exchanges. About 51% happen outside of the United States. We're a global economy, so we want to tap into those markets because, and say, US is having a tough day, but our friends over in Europe across the pond are having a much better day than we want. We want to tag into those places. Global funds include the United States and then other countries outside. And you can have developed markets from growing countries or emerging markets as well. Sector funds, specific sectors. You might be the finance industry that has banking and investment firms, or like the healthcare industry that has pharmacy and hospitals, and you can pick that particular sector. These do tend to be more risky because you're in only one sector. So think of the energy sector, right? Where you have oil companies, and let's say OPEC decides they're going to slow down production or pick up production of oil. That's going to affect oil prices, and we might see huge swings in the market from there. And then we have aggressive growth funds, which are companies, no, they're not looking for income or give income, but they're trying to maximize growth. And we could see huge swings. A big common example we're seeing this week is NVIDIA, right? We saw earlier this week the price tanked and then it's been slowly coming back up. And so you can see huge swings in the market. So the idea is you have these options, even though you have quite a bit of options available to you, but they're there to help you decide what work and give you that diversification to then get you where you want to be, because you're looking for those gains, you're looking to grow your investments and help you get to your goals. Aren't we doing that, Jesus?
Yes, and I hope, Diane, that this helps to answer your question. As Diana was saying, there are like all of them, they work
Right.
at a different pace. They do have like different level of risk, and the idea is for you to choose in
Mhm.
between the options that you do have, and knowing your risk, then you can take the full advantage of all of them. So definitely answering your question, Dion, it will be where to start, knowing your risk and going through your options. Then you can decide where to invest. Now, speaking of investment, and as Diana was saying, there are some funds that will give you some sort of income. But here it comes the topic that we don't like to talk about, which is taxes. Okay, I always tell Diana that my dad always says two sure things in life. One of them, we're gonna die. The next one, we're gonna pay taxes. And as a matter of fact, they may found the eternal life elixir or something like that. So for sure, taxes, right? Now, you may want to be aware of it because, as we said, there are some type of income that your investment can give you, and that can be added to your income, and you can end paying taxes on that. With that said, we are not disencouraging you to invest. Investing is the best way to have your money working for you, yes, but we just want you to be aware of your taxes because, yes, you may be ending paying on taxes, or you may paying your taxes. As a matter of fact, there is a very, I would say, fun fact that says that 60% of the federal income taxes is paid by 5% of the most wealthiest taxpayers. And what does that mean being part of that 5%? Is having an adjusted gross income a little bit over $208,000. Is it doable? Maybe it's not. I don't know. That depends on your personal situation. But we wanted you to know that if you may be falling within these 5%. And based on that, you may want to select what type of investment you want to do. Do you want to have like an income, some sort of income of your investment? Just want the growth and just wait until you actually sell those shares on your fund. Well, this is something that you may want to keep in mind. Because Diana, if you help me with the next slide, please.
Yeah.
Thank you. So, because that will be added, as you can see, on your 1040. Yes. So there is a 1040, like your 1040 form of your taxes, and there is a line that it says like an actual capital gain or losses. That is where you will add your money from your or taxable interest from your investments. So once again, you will be ending paying taxes on your earnings, but do not panic. There are some vehicles that will help you to both either save your taxes today or even not to pay taxes at all. So let me tell you a little bit about it. So what about the tax exempt options? Remember that Diana was talking about the municipal bonds? Well, those municipal bonds are generally tax-free. So with the interest that you will be getting out of those municipal bonds, you will not be paying taxes on them. Also, and that's going to help us, Dion, to help you out a little bit more with your questions. I mean, with your question, you have the Roth options both on your IRA or in your 401k if your employer offers that. The Roth option, the Roth money essentially is money after taxes. So basically, that money has the label after taxes. So you already pay taxes on that. And I know that you may be saying, like, Jesus, you told me that you will tell me not to pay taxes. However, let me go a little bit slow about it. Because on your Roth IRA, you pay, or in your Roth options, you pay your taxes up front, yes. But guess what? The earnings will be tax free. So you will not be paying taxes on the earnings. And if you are wondering yourself, how big can it be your earnings on your 401k? I can tell you it can be a big part of your account. The estimate is that in about 19 years, the money that you are putting today in your 401k, it's going to be tripled. So yes, earnings can be a big
Wow.
part of your 401k or your IRA. If you are putting that Roth, then the earnings will be tax free. And I just want to make a disclosure here. It's going to be tax free if you meet two criteria. One of them, you are older than 59 and a half when you get a withdrawal from your account. And the second one, it has been more than 5 years since you have this account. If these two are met, the earnings are totally tax free. With that said, I am not saying the Roth IRA or Roth 401k it's the better option. What we are saying is that you do have that option for you to save in your taxes in the future. Now, if you want to save the taxes today, you do have other vehicles, what we call tax deferred vehicles. Essentially, you are deferring the payment of your taxes until the day when you gotta withdraw from your account. Those options may be your traditional IRA. You can open an IRA, not Roth IRA, a traditional IRA. Basically, the money that you are putting in your IRA will be deducted of your taxable income. That works the same within your 401k or your 403b, your employer-sponsored retirement plans. The money that you put in those plans, if you decide to select that as a tax deferred, that will be deducted of your taxable income. Remember that we were talking about those taxpayers of a little bit over $208,000. If you don't want to be on that group, you can use that option. You can deduct this income from, I mean, those amount from your taxable income. As well, there are some annuities option where you can found them with after tax money. So those are really good options for you to defer your taxes. But let me just stop over here because I know that you may be thinking like, Jesus, at the end of the day, I will be paying taxes. What difference it makes? It makes a difference. So, as a matter of fact, let's look at the screen right now. Let's look at the slide that we are on the screen, that is on the screen right now. Let's say that you save, let's talk about like 40 years. Let's go all the way through 40 years. And let's say that your tax income or your tax rate as of right now is the 24%, right? You are on a tax rate of a 24%. And you save up to a little bit over $800,000. If you pay the taxes throughout your working life, you may be ending saving a little bit more than 560,000. Now, if you waited until retirement, then you may be paying a little bit less. Then you may be on a lower tax bracket. Why that happens? Well, it happens because usually, and I am quoting this because that necessarily applies to everybody, but usually during retirement, our income is lower. If our income is lower, then our tax bracket tend to be lower as well. That means that if I wait a little bit, I may be ending paying less taxes when I retire. As I said, that doesn't necessarily mean that it applies to everybody, but you can take advantage of it. Okay. Because there are also some other, I would say, the potential tax savings in your IRA that you may want to be looking at it, right, Diana?
Yeah, certainly. The tax deferred option could be really beneficial if you're saying, I'm in a high tax bracket now, and in retirement, I think I'm going to be in a lower one. So you want to then wait to pay the taxes later. And with an IRA, that's a little bit different from the 401k plan, is usually the money's already in your bank account and you have paid taxes when you make the traditional IRA contribution. So then where's the benefit? You can then potentially, depending on, if you fall in the proper tax phase out limits, so definitely talk to a tax professional when it comes to taxes, that you can take a tax deduction. And the numbers that we see here for this example, in this calendar year of we're in 2025, I'm already forgetting what year we're in. The amount you can contribute to a traditional IRA is 7,000 for those under 50. If you're 50 and older, you're able to put in 8,000 for a catch-up contribution. Now, what this chart is showing us, as you go down the line, and depending on where your tax bracket falls, is how much you can deduct and sort of your tax savings on taking the full deduction. So then you get to then save this money and reduce your taxable income for the year. And that's how you're able to take that tax deduction when it comes to an IRA, which is a little bit different from the employer sponsored plan, since you're already making pre-tax contributions and you don't have to worry about it there. But with your IRA, you might be able to get this benefit. And as you can see, the more you make, the bigger the deduction you can potentially get. So those of you who tend to be in higher incomes, you can then really benefit yourself as you're trying to reduce your taxable income for the year, or as things are going along and you are paying taxes. So please, please, please talk to a tax professional to make sure you are getting the biggest bang for your buck when it comes to taxes on that front. Now, additionally, with your employer sponsored plan, there are other benefits that you get that I'll have Jesus tell you about.
Thank you, Diana. Yes, as Diana said, and just keeping, I would say, thinking of the very last slide, the limits on the IRA are a little bit, well, not a little bit, are way lower than employer-sponsored employer-sponsored retirement plans. As I said, the accumulation is tax deferred. If you decide to do so, you may also have the option to do Roth. If you want to do so, then you pay the taxes today and then forget about paying taxes in the future of your earnings. Also, and this is something that I like the most, employer matching. Let me tell you a little bit about this. So let's think about an employer that is matching 100% of your contributions, let's say up to the 6%, just to make a number. And think about this. If you are putting 6%, you are getting 100% as a rate of return instantly. So you are getting an additional 6% from your employer in this example. I will say, go ahead, look into your 401k if your employer is offering your 401k, and look if there is any kind of matching. When my participants ask me if I don't do anything else on my 401k, I always tell them at least get the maximum matching from your employer. That's free money. That's money that your employer is giving to you, and you can please take advantage of it. It's better on your pocket than in the companies, right? Now, as I said, the annual contribution limits, it's higher. So for this year, if you are younger than 50, the limit contribution is $23,500. If you are over 50, they are giving you an additional catch up, which is $7,000 more. So you can save up to $30,500 in your 401k or your 403b. So as you can see, there are, I would say, like benefits that your employer-sponsored retirement plans will give you. There are also benefits on the IRA. The IRA is more, you have more control on your IRA. Yes, but so you can have or you can use both. We want you to be aware of it. And I just see a question here. It says like, is it not $7,500? No, for the IRA, they didn't change that for this year. They didn't increase the limit. So last year it was $7,000. This year is the same $7,000. The only $500 additional that we saw is in your 401k, and just as the regular limit. the match, I mean, the catch up, it was also, or is also $7,500. Is that correct, Diana? Just to confirm.
Yeah, that's from what my understanding as well too.
Yeah,
didn't change for this year.
perfect, great. Yeah.
Mhm, mhm.
And now, so with this in mind, when knowing that you can use an IRA or either you can use your employer savings retirement account, I would say the next step that we want to talk about is your retirement, and that's something that Diana can help us.
Yes, exactly. Especially with the employer sponsored plan. And then following thereafter, when you max it out, you have those IRAs. This is a big goal for all of us, right? Saving for retirement. And in this goal, when you're saving for retirement, yes, we know we have to do that. But what are we saving for? I have another poll question to ask. What would you like to do with your retirement? We ask this because you need to make a plan for the future. Some of us, usually the top answer tends to be travel. We want to travel, whether it's domestic or we have a bucket list of places we want to go to internationally, right? Or they're hobbies that we enjoy doing now that we want to continue into retirement. We're seeing pickleball has hit the world by storm and people love playing pickleball. Or maybe you want to just catch up on some snoozing. We had to wake up real early every day for work. And now we want to rest a little bit. Whatever it may be, feel free to share with us. But as you are saving for your future, it's super, super important to make that plan, huh, Jesus?
I'm sorry, Diana. I'm sorry to cut you off. I just want to add another one on the D option. What
Yeah.
about like sleeping on a cruise with
Ooh.
piña colada? Does that sound
Ooh, I
good?
like that. I like that.
Okay.
Folks are starting to retire on cruises. So I'm into that. Give me some time to relax, hang out, not have to worry, sip a colada, no problem. That's a good life. So, but I get my savings going on that too. But you definitely want to make that plan because not only for yourself, but like especially anyone out there who has a partner, spouse, whatever it might be, talk to them because you might be like my parents. Because talking to my parents about retirement, they have very different ideas. My dad is a track and field coach. He ran all his life. He loves it. He wants to coach until he drops dead one day. My mother, not so much. She was also a coach, but now she wants to live her best life. She wants to actually travel and have fun. She loves Volvos. So she wants to go in North Carolina. There's a museum. She wants to go to the Swedish museum. So they have very different plans for retirement. And when they talk, it is funny to me because I'm just like, good luck at this point. But it's great to think about. And we're seeing lots of answers coming in, travel being the top one always, right? I've seen someone put that they want to travel to see all the national parks. Great idea, right? So start creating that plan and then talk to your spouse because when you're thinking about your retirement and creating that retirement plan, what do you think about? And how do you know what are you saving for? Because the cost of it will depend on what you do. Some people are saying, I want to do all the above. If you want to do all the above, let's start making sure we're planning for that. Some of us, when we're thinking about when we want to retire, we always say the sooner the better, right? So you want to actually think about your age. When do you actually want to retire? We might want to retire early, but retiring early might not be the best for us. Some might really, really enjoy what they do. And it looks like Steve here says he doesn't want to retire. Steven doesn't want to retire because you really might enjoy what you're doing. So think about what that looks like. Steven, you and my dad would have the best time ever talking about that and trying to convince my mom because she's ready. She's done. Lifestyle. Jesus and I were talking about this. Lifestyle is so important in what you do. Hi, Jesus. Tell them what you told me.
Oh yes, no, and that I know that all this presentation is about numbers and it's about finances, but you may want to think about your personal life, your like a person. I was telling Diana that we are used 30 years, maybe 40 years, to wake up
Mhm.
at the same time, take a shower, have a breakfast, go to work, come back home, have dinner,
Yeah.
go sleep, and go over it again for 20, 30, 40 years. So at
Right.
some point, when you get to retire, it's like, what am I doing with so much time? You have no idea how many retirees we have seen that after 3 months, 4 months, they decide to go back to work because they don't know what to do at home. So I always tell my participants when I do have my one on ones, even when you are planning for all your money on your retirement, yes, but keep in mind what you are going to do with with the time that you do have now that you are retired.
Yeah, no, I 100% agree on that. What you do will affect how your retirement outcome is, just your physical health, which leads us to the next one of length of your retirement. That's where you look at your medical history, your family medical history. On my mom's side, we don't die. My great grandmother lived to 110. So I seem to be taking up those genes because my grandmother, my mama, they're still here and they're still kicking. And sadly on my dad's side too. Great. It's a wonderful blessing, but it's gonna be a long retirement for me. So then I have to think about how long is that gonna last and make sure I'm saving enough to plan for that and to plan how my money is gonna last for my retirement years. And then the next two are really, really important, your income sources and your tax situation, because they go hand in hand. Your income sources, you have your guaranteed one. So you have Social Security. Some of us may have pensions. Some of us might have an open an annuity, buy an annuity. Those are what we call guaranteed sources of income because every month you're going to get a specific amount every month, and that's not going to change. Compared to your variable sources of income, what you saved for, your what's in the IRAs and the employer sponsored plans, those 401k and 403bs, or maybe any additional taxable accounts you've put money aside to save for at that point in time that you want to keep in mind. And then how you saved in those accounts and how you're spending your money affects your tax situation, doesn't it?
Correct. Yes, and as a matter of fact, that goes also with the retirement age, because so pretty much like all of this is just like a general plan. Because think about this: if you retire, I see the Evangeline question that says, "How do I know what age should I retire?" And Evangeline, I guess there's no answer to that question. I guess that you may know the best answer to that question when you are ready, but as we've been talking about, the retirement age is so important, and the income source, the tax situation. Because think about this. Let's say, I don't know how old you are, but let's say that you are 55 years old and you want to retire already. You may need or you will need to pay for your health insurance. And that
Mhm.
health insurance can be
Mhm.
expensive. That can be a huge expense on you during retirement. So let's think about 10 years until actually your Medicare starts, then you will be responsible for those 10 years. That's
Right.
why, Evangeline, there is no single answer to that question. Like, how do I know? I will say when you are emotionally, personally, and financially ready. When you are ready is the best time, and that is different for every one of us. Now,
Right.
that takes us to the last step. Remember that I told you two things for sure in life. One is paying taxes. We talked already about it. And the next one is death. We all gonna die. We
Mhm.
all are gonna die. So what's gonna happen when we die? We want to leave a legacy. And there are some ways for you to leave a legacy and to leave less problems, I would say, or less worries to your family, right? There are different techniques, there are different vehicles that goes for from a will. You can set up a will, you can put in on a piece of paper actually what do you want for your assets to happen with, who do you want to take those assets, and you can decide how is it going to be distributed. Also, you can have joint health accounts either with your spouse or maybe with your partner if it's for a business, or if it's from I don't know, your daughter, your kid, your son, depending on who or what's your current life situation, you can have those joint health accounts. Essentially, with a joint health account, when you pass, basically whoever is the co-join on the account, they will be taking that account, or they will be responsible for that account. Also, you will have different contracts, meaning life insurance. Remember that at the very beginning we were talking about like different insurances. Well, life insurance is one of them, where you can actually protect your family in the event when you pass. Also, there are some annuities, some pensions, your IRA, even your 401k, and we will be talking a little bit about it, like what's going on with our 401k. Because before we actually talk about it, let's talk about trust. Trust essentially is putting like a set of rules. You can set up all the rules that you want for your assets to be distributed. Both it can be and when the time when you pass, or if you can decide to start taking care of it as of right now, or if anything happens and you are disabled to take any decision. But with all of this, the idea is to avoid your family to go to probate.
Whew.
I can tell you, probate is the ugliest process ever.
Yeah.
We have seen so many families because when you are talking about your IRA or your 401k, if you don't have a beneficiary, they will need to go through a probate court. That's going to be expensive because they will need to pay court fees, and that's going to be so much time consuming. So on top of grieving with the pain that they lost you or they lost whoever passed, they will need to invest money and time to this process. The easiest way to avoid this is to enter your benefit, to be sure that we do have your beneficiaries, and that all of your accounts do have some beneficiaries. In case of anything happens, they can take your account. And I want to give you, I would say, like a heads up. If you are married, your spouse need to be your primary beneficiary 100%, even if you don't want. Yes. So your spouse will need to be your primary beneficiary 100%, unless that you have a waive signed by your spouse, by yourself, and by a notary. Before to do so, you will need to have a very awkward conversation, I can tell you. But so if you don't want to have that conversation, you can add your primary beneficiary, your spouse, if you are married, and then you can add a secondary beneficiaries. As we were talking about the trust, as you can see, there are another way is the trust. And Diana, tell us a little bit about it.
Yeah, yeah. Hopefully, if you both decide together, maybe less awkward of a conversation is you want to have your joint trust as the beneficiary of the employer sponsored plan. In some scenarios, that might occur. There was a question that asked, how much do trust cost? It depends on your state and where you are. So please talk to an estate attorney about trust, because there are also various types of trusts you can set up. You can do a living trust, which is a trust while you're still alive. You would be the trustee or the grantor, the person who created the trust, and you would manage the trust while you're alive. Or you can have a trust that's created with your last will and testament, called a testamentary trust. I always have to sound it out with that one. That when you pass on, the trust goes into effect. And you can be, as Jesus said, as detailed as you want to be, where the money is going to go. Maybe you have a specific amount going for your kids education. Some, if let's say you have no kids but you have pets, you want money, your pets are going to go to your siblings and you want them to be not stressed over taking care of them. Or if you want to give money to your favorite sibling and less to your least favorite sibling because they mess with you too much growing up, you can do that too. You can be as detailed, or even give it your alma mater, charities, how you want that dictated in your trust, and how you want your various accounts distributed. You can do that as well. In your trust, when you set it up, for, let's say, a taxable account, you can have it as the primary beneficiary, or you can have it as a secondary beneficiary to, like, let's say, an IRA. Let's say you want your spouse to be primary, and then if, let's say, you both happen to pass away at the same time, the trust would then kick in thereafter. So you can set it up how you want to. And of course, first talk to your state attorney to learn not only your federal laws, but your state laws for your states, because that might look a little bit different on how you even set those up for the future and make sure they work for you. Now,
I don't know,
along,
Diana. I'm
uh-huh,
sorry. I don't know
mhm.
if it was intentional, but you actually answered Angeline's question because she's
Oh,
wondering if it has if it's your primary or secondary beneficiary. So
oh,
you can set up your trust either if you want to do your primary. However, once again, go back to the spouse. If your spouse is alive, then he or she will need to sign that waiver of right to your trust to be your primary beneficiary, right?
mhm.
Then is asking about what about the spouse and children as beneficiary. You can do that.
Absolutely.
It's the same. Yeah, perfect. You can do have your spouse, and however, your spouse will need to be your primary beneficiary 100%, and then
Mhm.
your children as secondary. Now,
Yeah.
I guess that conversation may be a little bit less awkward if you tell them like, "Hey, honey, I don't want our kids to be our primary
Mhm.
beneficiary." Then your spouse may sign that waive for your kids. Also, if your kids are underage, then you can set up a trust. The trust is the best way to avoid any potential legal issue for them to claim that account if they are underage. Right, Diana?
Absolutely. You can set up a guardian who's going to take care of your kids until they're of age, and then how you want the money dispersed thereafter can go. There was a question asking why 100% for the spouse. So with 401ks, the employer sponsored plan are the ones where your spouse is primary 100%, and that's just law. It's law that happened, gosh, I don't know how long ago, that your spouse is 100% primary unless they sign the waiver to then not be. Then you can put somebody else on there. So, and so even though if for unfortunately if you got divorced, then and you go to you become divorced and you remarry, if you haven't updated your information, it's going to the spouse that's on there. So you want to think about that. Now, along with that, additional documents that you want to add in your estate file is what we call estate documents for if you become disabled, incapacitated, with power of attorneys. Now, keep in mind if you set up a power of attorney for any financial items, please let the financial institution know where you're setting that up because they may also have their own documents that you will need to fill out along with the power of attorney. Now, with a power of attorney, durable power of attorney, you might hear limited power of attorney, medical power of attorney. You can get different kinds for different needs. Usually, a regular one, a general one, will be able to cover both legal situations, financial situations. Durable have more power than limited. Limited could be for a specific financial transaction, maybe the sale of your home, where a durable could be the sale of your home and all your financial. Medical, in case you're not able to make any medical decisions. And a living will also helps with if you had like a chronic or terminal illness, to you can state what you want to happen, whether it's like a do not resuscitate type thing or something of that, to not intubate you. You can be that specific with these documents on what you want to occur for yourself. Anything else you want to add, Jesus, on that?
Just adding to the power of attorney, that can be for, I would say, any type of situation. You can set up a power of attorney in the case that you passed. As Diana said, if you become, I don't know, like disabled, either if you become like totally disabled or if you are partially disabled, or as I was telling Diana, let's say for instance, now the situation that we are seeing with the deportations, if you are in a situation where, or you or whoever you know, it is in a situation where they can be deported, they can also set up a power of attorney to manage their financial, to manage the assets that they leave behind. So that power of attorney is very flexible. It will give you very options, either as I said, if it's today, if it's something happens, or worst case scenario when you pass, right?
Yeah,
Diana, I don't
yeah.
know if you would like to add anything else.
No, I think that's great. And of course, folks, with that, we are coming up to the end of the presentation. Of course, we want you to connect with us. If you need to, at the bottom, you'll see like a news line come up. If you have any additional questions, feel free to send those in and get the help you need. Of course, thank you for joining us today.
Thank you, everybody. As Diana said, you are seeing the email. Feel free to send us your email if you have any question. Thank you for joining us. Thank you, Diana. Thank you for being here today with me. My pleasure sharing this with you.
Thank you.
Thank you. Have a great day, everybody.
All right. Take care.